Have you ever wondered why it seems like the less money you have, the more your bank charges you? You check your balance and you see a $35 overdraft fee. Then, because your balance dropped below zero, you get hit with a $15 negative balance fee. Then, because you didn't meet the $100 minimum daily balance requirement, you get slapped with a $12 maintenance fee. In the span of 72 hours, you've lost $62 to the very institution that is supposed to be safeguarding your money. It feels like a trap. It feels like you're being punished for being broke. And the truth is, you are. But it's not a glitch in the system. It's not an accident. It is the exact business model of modern retail banking. Banks don't just tolerate low-income customers. They actively rely on them. They love them. Because poor people, or rather people living paycheck to paycheck, are the most profitable customers a retail bank can have. Today, we are pulling back the curtain on the entire banking industry. We are going to look at the dark mathematical truth about why banks love poor people, how they legally extract billions of dollars from those who have the least, and most importantly, how you can break out of this system and start keeping your money in your own pocket. Make sure you hit the like button and subscribe, because this is the financial education they deliberately didn't teach you in high school. Let's dive in. Let's start with the biggest lie the banking industry has ever sold the American public. Free checking. Walk into any major bank branch in the United States, Chase, Bank of America, Wells Fargo, Citibank, and you'll see signs promoting their free checking accounts. It sounds amazing. It sounds like a public service. They are offering to hold your money, protect it, and give you a debit card for the low price of $0. But let's read the fine print. To get that free account, you usually have to meet one of several conditions. You must either have a direct deposit of at least $500 a month, or you must maintain a minimum daily balance of $1,500, or you must keep a combined balance of $5,000 across all your accounts. Now, for a middle-class professional earning $80,000 a year, keeping $1,500 in a checking account is effortless. It's just a buffer. They don't even think about it. But for the 60% of Americans who live paycheck to paycheck, keeping $1,500 in a checking account is impossible. Every dollar that comes in on Friday goes straight to rent, groceries, utilities, and gas by Monday. So, what happens to the paycheck to paycheck worker? They fail to meet the minimum balance requirement, and suddenly that free checking account turns into a $12 or $15 monthly maintenance fee. Let's do the math on that. $15 a month is $180 a year. If you only have $300 in your account at any given time, paying $180 a year just for the privilege of having a bank account means you are paying an effective annual rate of 60% just to access your own money. Imagine if a bank tried to charge a rich person a 60% fee to hold their money. They would move their millions to a private wealth management firm in a heartbeat. But the poor? They don't have that option. They need a bank account to cash their paycheck, to pay their bills online, to exist in the modern digital economy. So, they pay the $180 a year. The banks know this. They have calculated exactly how many people will fall below that threshold, and they have built it into their revenue forecasts. Free checking isn't a product, it's a funnel. It funnels the people who can't maintain a balance into a high-fee subscription model, while the wealthy get the actual free service. It is a reverse Robin Hood system, where the poor subsidize the banking experience of the rich. If the monthly maintenance fee is the bank's bread and butter, the overdraft fee is their caviar. In 2022 alone, American consumers paid over $9 billion in overdraft and non-sufficient funds fees. And here is the most staggering statistic of all. The vast majority of those fees, around 80%, were paid by just 9% of account holders. And who makes up that 9%? You guessed it, people with low balances, low incomes, and volatile cash flows. Let's break down how the overdraft trap actually works, because the mechanics of it are genuinely brilliant in a purely evil, corporate sort of way. Imagine you have $50 in your checking account. You go to the gas station and swipe your debit card for a $5 coffee. The bank approves it, you now have $45. Later that day, you go to the grocery store and buy $40 worth of food for your family. The bank approves it. You now have $5. On your way home, your car's check engine light comes on. You stop at an auto parts store and buy a $15 bottle of coolant because you need to get to work tomorrow. You swipe your card, you only have $5. You should be declined, right? No, the bank approves it. They spot you the $10, pushing your balance to Dallin 1010. And for the privilege of spotting you that $10, they charge you a $35 overdraft fee. But wait, it gets worse. 5. Let's look at how banks process transactions. Banks have a little-known policy called high-to-low posting order. This means that at the end of the day, the bank doesn't process your transactions in the order you made them. They process the largest transaction first. Why do they do this? Because it maximizes the number of overdraft fees they can charge you. Let's replay that same scenario. You have $50. You buy the $15 coolant first, the $40 groceries second, and the $5 coffee third. If they process it chronologically, you would only be overdrawn once on the coffee, one $35 fee. But with high to low posting, they process the $40 grocery bill first. Your balance drops to $10. Then they process the $15 coolant. Your balance drops to $5. Boom, $35 overdraft fee. Then they process the $5 coffee. Your balance drops to $40. Boom, another $35 overdraft fee. By simply changing the order of the math, the bank just turned a $35 fee into a $70 fee. You didn't spend any extra money, but you now owe the bank $70 more, all because you were $5 short on a Tuesday. Banks have literally been sued over this practice. Some have settled and changed their policies, but the core system remains. Banks make billions by offering overdraft protection, which is just a fancy term for a predatory short-term loan. Let's look at that loan. If you overdraw your account by $10 and get hit with a $35 fee, and you get paid 2 weeks later and cover the negative balance, what just happened? The bank loaned you $10 for 14 days and charged you $35 for it. If you annualize that interest rate, you are looking at an APR of over 18,000%. Payday lenders get thrown in jail for APRs a fraction of that size. But major banks, they call it a service. They claim they are doing it so your card doesn't get declined at the register. They claim it's to save you from the embarrassment of being denied in public. Don't fall for it. The bank doesn't care about your embarrassment. They care about their $9 billion. And they know that a wealthy person with a $20,000 buffer in their account will never ever overdraw. The overdraft empire is built entirely on the backs of the people who can least afford it. We touched on minimum balances earlier, but let's go deeper, because the psychology behind minimum balance requirements is one of the most insidious things about modern banking. When a bank demands that you keep a minimum daily balance, say $1, $500 to avoid a fee, what they are effectively doing is locking your money in a cage. For a low-income earner, $1,500 is an emergency fund. It's the money they might need if their car breaks down, if their kid gets sick, or if their hours get cut at work. But the bank says, if you touch this money, we will punish you. So, what does the poor person do? They scrimp and save. They skip meals. They put off buying new shoes for their kids. They sacrifice to keep that $500 in the bank to avoid the $15 fee. And what does the bank do with that $500? They don't just let it sit in a vault. They leverage it. They lend it out. They use fractional reserve banking to turn that $1 $500 into $15,000 worth of loans, earning 5%, 10%, or 20% interest on it. The poor person is essentially giving the bank an interest-free loan of $1 to $500 under the threat of a penalty if they touch it. The bank takes that money, leverages it, and makes a fortune. The poor person gets nothing but anxiety, constantly checking their app to make sure they haven't accidentally dropped to $1,499. It is a hostage situation. The bank holds your liquidity hostage, and the ransom is $15. If you are living paycheck to paycheck, that $1,500 minimum balance is a fiction. You are going to dip below it. You are going to pay the fee. The bank knows this. The minimum balance requirement isn't a goal. It's a trapdoor they know you will eventually step on. Now, let's talk about how banks capitalize on the desperation that they themselves help create. When you are constantly being drained by maintenance fees and overdraft fees, you eventually run out of money before you run out of month. You need cash to survive. You need groceries. You need gas. Enter the credit card. Major banks issue the vast majority of credit cards in the United States. And who gets the highest interest rates, the worst terms, and the lowest credit limits? People with low credit scores, usually because they missed a payment on a medical bill or because their bank reported them for an overdraft cycle. Subprime credit cards often come with interest rates of 29.99% or higher. They often come with annual fees of $75 to $99 just to open the account. And the credit limits are usually tiny, maybe $300 or $500. Here is how the trap works. You get a $300 credit card to use for emergencies, but the annual fee is $75. So before you even swipe the card, your balance is $75 and your available credit is $225. Because your limit is so low, it's incredibly easy to max out the card. You buy $200 worth of groceries, and suddenly you are at 91% credit utilization. The banks report this high utilization to the credit bureaus, which immediately lowers your credit score even further. Because your score drops, your interest rate on the card doesn't go down, it stays at the maximum. Now, you can only afford to pay the minimum payment, which is usually $25. But with 29.99% interest, $20 of that $25 goes straight to interest. You are now on a treadmill. You are paying $300 a year to the bank, but your balance is barely moving. You are a permanent source of passive income for the bank. And if things get really desperate, many banks offer direct deposit advances or partner with payday lenders. These are short-term loans against your next paycheck. The fees on these loans equate to APRs of 300% to 500%. The banking industry essentially created a pipeline. Step 1. Drain the poor person's checking account with junk fees. Step 2. Offer them a high-interest credit card to fill the gap. Step 3. When they are drowning in credit card debt, offer them a payday loan to make the minimum payments. At every single step, the bank is extracting wealth from the bottom and funneling it to the top. They aren't just taking your money, they are keeping you in a perpetual state of financial servitude. To truly understand why banks love poor people, you have to look at how they treat the wealthy, because the contrast is staggering. When you have a net worth of $500,000 or $1 million, you don't get free checking. You get private banking or priority banking or wealth management. And let me tell you what private banking looks like. First, there are no monthly fees. No minimum balance threats. In fact, the bank will often waive any fee you ask them to, just because they want to keep you happy. Second, there are no overdraft fees. Why? Because wealthy people have lines of credit tied to their accounts that automatically cover any shortfall. If a wealthy person overdraws by $10,000, the money just quietly flows from their brokerage account to their checking account with an interest rate of prime minus 1%. No penalties, no $35 fees, no phone calls. Third, wealthy people get paid to keep their money in the bank. They get sign-up bonuses of $900, $1,000, or even $3,000 just for opening a checking account and depositing $100,000. They get free wire transfers, free cashier's checks, free notary services, and access to airport lounges. Some banks even have dedicated concierges for their wealthy clients. They will help you plan your vacation, secure tickets to a sold-out concert, or help your kid get an internship. Do you see the difference? If you are poor, the bank looks at your $300 balance and asks, how can I extract $15 a month from this person without them leaving? If you are rich, the bank looks at your $1,000 balance and asks, what free services can I provide to this person so they don't move their money to my competitor? The poor are the profit center. The wealthy are the loss leader. Retail banking relies on the fees from the bottom 20% of earners to subsidize the perks for the top 20%. The wealthy get free banking because the poor are paying for it. The entire infrastructure of the retail bank, the branches, the ATMs, the apps, is funded by the people who can least afford it. Banks love poor people because poor people are the donors keeping the banking machine alive. What we've discussed so far is purely financial, but the damage goes much deeper than dollars and cents. The banking system inflicts a massive psychological toll on low-income Americans. When you are poor, checking your bank app isn't a casual habit. It's an act of survival. It induces anxiety. Every time you open the app, you are bracing for a negative number, a pending fee, or a charge you forgot about. This constant state of financial hypervigilance drains your cognitive bandwidth. There is a famous psychological study that showed that worrying about money reduces your IQ by about 13 points. It's called the scarcity mindset. When you are constantly worried about a $35 overdraft fee, your brain doesn't have the capacity to think about long-term planning, investing, or career growth. You are stuck in survival mode, and the banks capitalize on this cognitive depletion. They know that a person stressed about money is less likely to read the fine print. They are less likely to call customer service and dispute a fee. They are less likely to shop around for a better bank. They just accept the fee, sigh, and try to figure out how to make it to Friday. This is perhaps the most insidious part of the system. The fees don't just take your money, they take your peace of mind. They steal your mental energy. They keep you trapped in a cycle where you are too exhausted fighting today's bank fee to plan for tomorrow's wealth. Banks don't just extract wealth, they extract hope. So what do we do about it? How do we stop being the bank's favorite ATM? You break the system by changing the rules of the game. You stop playing on their field and move to your own. Here is your blueprint to escape the retail banking trap forever. Step 1. Switch to an online-only bank or a credit union. This is the single most important move you can make. Traditional brick-and-mortar banks have massive overhead. Thousands of branches, millions of square feet of real estate, thousands of employees. How do they pay for that? Your fees. Online banks like Ally, Discover, or SoFi don't have branches. Their overhead is a fraction of a traditional bank. Because of this, they don't charge monthly maintenance fees. They don't have minimum balance requirements. And they actually pay you a high yield on your checking and savings accounts. Right now, many online banks pay 4% or 5% APY, while Bank of America pays you 0.01%. Alternatively, join a credit union. Credit unions are not-for-profit organizations owned by their members. Their entire purpose is to serve you, not shareholders. They typically have zero fee structures and much more forgiving overdraft policies. Step 2. Opt out of overdraft protection. This sounds counterintuitive, but do it today. Call your bank or go into your app and turn off overdraft protection. What happens when you do this? If you go to the grocery store and try to spend $40 but only have $30 in your account, your card will simply be declined. It will be slightly embarrassing. Yes, but you know what won't happen? You won't be hit with a $35 fee. You will just hand the cashier a different card or put an item back. By opting out, you remove the bank's ability to charge you that 18,000% APR short-term loan. You force the bank to simply say yes or no to your transaction rather than saying yes, but it'll cost you. Step 3. Build a $500 buffer. I know this is easier said than done, but the ultimate defense against bank fees is a small cash buffer. If you can find a way by selling things around the house, by picking up a side gig for one weekend, by cutting a subscription for 3 months, to put a $500 buffer in your checking account that you never touch, you eliminate 90% of the triggers that cause overdrafts. Treat that $500 like it doesn't exist. It is not spending money. It is a fee prevention shield. Step 4. Use the right tools. If you struggle with tracking your balance, use a budgeting app like YNAB, You Need a Budget, or Monarch Money. These apps connect to your bank and show you exactly what you have available to spend before you swipe your card. Don't rely on the bank's app. Their app is designed to confuse you about what is pending and what is cleared, hoping you make a mistake. Step 5. Automate your alerts. Set up a text alert for when your balance drops below $100. This gives you a final warning to stop spending before you cross the line into fee territory. By taking these 5 steps, you effectively stop the bank from treating you like an ATM. You move from being a fee target to being an unprofitable customer. And when you are unprofitable, the bank will leave you alone. That is the goal. As you start to implement these changes, I want you to think about the bigger picture. The banking system is just the first level of the wealth extraction machine. Once you fix your banking, you'll start to notice the other systems that treat poor people differently. Insurance is a great example. If you have bad credit, you will pay higher premiums for car insurance, even if you have a perfect driving record. Why? Because statistically, people with bad credit file more claims, so the poor pay more for the exact same coverage. Taxes are another one. If you are a W-2 employee making $40,000 a year, you pay taxes on every single dollar you earn. But a billionaire who makes $100 million in stock appreciation, they pay 0 taxes until they sell, and if they use a strategy called buy, borrow, die, they never have to sell and their heirs get a step up in cost basis, wiping out the tax bill entirely. The system is designed to extract from the bottom and protect the top. But you are not a victim. You are a player in this game, and the first step to winning a rigged game is learning the rules. By understanding why banks love poor people, you have just armed yourself with the knowledge to stop being one of their targets. When you stop paying bank fees, you keep $300, $400, or $500 more in your pocket every year. When you take that money and put it into a high-yield savings account or an S&P 500 index fund, it starts working for you. Instead of the bank using your money to get richer, you are using your money to get richer. That is the shift. You go from being the product to being the owner. You go from paying interest to earning interest. You go from funding the banker's bonus to funding your own retirement. The dark truth about your bank account is that it was never designed to protect you. It was designed to profit off of you. The overdraft fees, the maintenance fees, the minimum balance requirements. They are all part of a beautifully engineered machine designed to siphon wealth from the people who have the least to the people who have the most. Banks love poor people because poor people are their best customers. They are predictable, they are desperate, and they are too busy surviving to read the fine print. But you are different now. You know the game. You know the trap. And most importantly, you know the way out. Close that fee-heavy checking account. Move to an online bank or a credit union. Turn off overdraft protection. Build your buffer. Take the $180 you were going to give Bank of America this year and put it into a fund that pays you. If this video opened your eyes, do me a massive favor. Hit the like button. It helps this video reach more people who need to hear this truth. Subscribe to the channel if you want to keep learning the financial secrets they don't teach you in school. Drop a comment below and tell me, what is the worst bank fee you've ever been charged? I read every single comment, and we are building a community of people who are waking up to the system. Stay vigilant, keep your money, and I'll see you in the next video.